Welcome back to Talk Tickers, where we break down the earnings calls that are really moving the markets. Today we are diving deep into Seaport Entertainment Group. That's ticker SEG. Their latest Q2 results are pointing to a huge strategic shift, and we're here to unpack exactly what that means for the company going forward.
You know, CEO Anton Nicodamus really set the stage with this one quote, "Building the right foundation." What he's really saying is we're fundamentally changing how we operate. They're moving away from being a complex real estate developer and transforming into a much leaner, focused operator in entertainment and hospitality. And honestly, this idea is the key to understanding everything we're about to go through.
Okay, so here's our game plan. First, we'll crunch the Q2 numbers. Then, we'll spotlight the real growth driver here, their entertainment business. That'll lead us right into their biggest strategic move, what they're calling the portfolio simplification play. After that, we've got to decode the market's kind of puzzling reaction to all this. And finally, we'll wrap up with our take on what to watch for.
All right, first up, Q2 by the numbers. And let me tell you, this is absolutely a story of improvement. Now, you might see the headline net loss and pause, but that is not the whole picture. Not even close. The real story is the huge operational progress they're making.
Wow, just check this out. A 55% drop in their G&A expenses. That's, the basic cost of keeping the lights on and running the company. They slashed it down to just $8.3 million. Now, a big reason for this was some one-time costs from last year that didn't repeat, but still, that is some serious cost discipline and a major step towards a sustainable business.
And what about revenue? Well, the top line looks pretty solid. They pulled in nearly $40 million, which is a nice 18% jump. But the really interesting part is where that money's coming from. Look at this breakdown. Entertainment is the undeniable star of the show, bringing in almost $20 million. This really just proves that management's big bet on this segment is starting to pay off.
So what does this all mean for the bottom line? Well, this is huge. They've managed to shrink their net loss from a whopping $35 million a year ago all the way down to just over $14 million this quarter. So no, they're not in the black just yet, but man, that combination of growing revenue and slashing costs, it is absolutely moving the needle in the right direction.
So where is all this good news coming from? What's the engine driving this thing forward? It is all about their entertainment segment. I mean, it is just firing on all cylinders. This quarter was basically proof positive that their big strategic pivot to live events was the right call.
I mean, this chart says it all. They literally doubled the number of concerts at their flagship venue, the Rooftop at Pier 17. We're talking going from 11 shows last year to 22 shows this year. That isn't just a small bump, that's a massive acceleration that's directly fueling both revenue and foot traffic.
And the results are just off the charts. Operating EBITDA, which is a great way to measure profitability, it surged an incredible 122%. Their ticket sell-through rate was over 90%, with 15 shows completely sold out. And get this, management even said they're outperforming similar venues across the country. This business is a well-oiled machine right now.
Okay, but it's not all perfect, right? While the entertainment side is booming, the hospitality segment, well, it's a different story. Management themselves called it a work in progress, which is kind of corporate speak for we're still trying to fix this. The big challenge is their massive tin-building food hall. They've got to get it stabilized and stop it from burning through so much cash. This contrast really highlights why that big strategic pivot is so critical.
And that brings us right to the centerpiece of their strategy, the portfolio simplification play. This is their big bet on focus. And let me be clear, this is not some minor tweak. We are talking about a decisive, company-altering move designed to unlock value.
So what does portfolio simplification actually mean here? It's a classic playbook, really. You sell off the complicated assets that aren't making your money to reduce risk, shore up your balance sheet, and then you take that capital and you pour it directly into the part of your business that's already winning. In this case, that's entertainment.
And here it is, the big kahuna. A signed deal to sell their 250 Water Street development asset for a cool $150.5 million. The company called it a significant milestone, and you know what? That might just be an understatement. This one deal fundamentally changes their entire financial footing.
You can really think of this as a strategic domino effect. Step 1, sell the asset. Step 2, that huge cash infusion strengthens the balance sheet. Step 3, that cash can then be used to fund growth in their core businesses. And what's the ultimate goal here? Step 4, hit operational break-even in 2026. It's a clean, logical, and really powerful plan.
So, with all this positive news flying around, strong growth, deep cost cuts, a massive asset sale, you'd expect the stock to just soar, right? Well, not exactly. The market's initial reaction was, to put it mildly, a bit of a puzzle.
This is the question that had a lot of investors scratching their heads. The earnings call was upbeat, the strategy was clear, the numbers were improving. So why on earth did the stock take a dip right after the announcement? What gives?
This timeline really tells the story. On the day of the call, boom, the stock fell 2.1%. But as the market had time to really digest what was going on, especially the massive implications of that Water Street sale, the stock didn't just recover, it rallied hard, posting a nearly 15% return over the next month. It just seems the market was a little slow to connect the dots.
All right, so where does Seaport Entertainment Group go from here? In our final section, we're going to outline the key catalysts you need to watch and give you our official rating on the stock.
Okay, here's your checklist for the next 6 months. First and foremost, they have to successfully close that Water Street sale by the end of the year. That's non-negotiable. After that, keep a close eye on the Q3 concert numbers, look for updates on new tenants like Meow Wolf, and listen very carefully for a clear plan on how they're going to use all that new capital.
Our takeaway is this: we are initiating coverage with an outperform rating. The rationale is pretty clear. You have the proven success of the entertainment engine, and you combine that with the massive de-risking from the asset sale. Together, that creates a really compelling path forward that, in our view, outweighs the current challenges in hospitality. We see the successful close of the Water Street sale as the next major catalyst for this stock.
This is not financial advice.